What triggers a CRA audit for non-resident landlords? For non-residents earning rental income from Canadian property, filing taxes under Section 216 might feel routine until one day the Canada Revenue Agency, CRA, decides to take a closer look. A CRA audit isn't always about wrongdoing. Sometimes it's a random review, but often it's triggered by red flags in your filings, payments, or record keeping. Knowing what these red flags are can help you prevent an audit before it starts. Here's what commonly catches the CRA's attention and how to keep your rental filings audit-proof. Inconsistent or missing income reports. One of the most common triggers is a mismatch between reported income and third-party data. The CRA cross-checks your Section 216 return against NR4 slips from property managers, tenant payment records, Airbnb or rental platform earnings, bank deposits and wire transfers. If what you report doesn't line up with what the CRA sees, an audit is almost automatic. Similarly, if your income fluctuates drastically year to year without clear explanation, the CRA may request supporting documentation. Unrealistic or excessive expense deductions. Claiming every possible deduction might seem smart until it looks suspicious. The CRA often flags returns where expenses seem disproportionate to income, are missing supporting receipts, include personal costs like vacations or furnishings for personal use, exceed industry averages for similar properties. They may request all invoices and receipts to verify your numbers. If you can't provide proof, deductions get denied and penalties can follow. Late or missing NR6 and Section 216 filings. If you routinely file your NR6 or Section 216 return late or fail to file at all, the CRA sees this as a sign of disorganization or non-compliance. Late filings can also cause withholding mismatches, another red flag that may trigger a closer look. Cash payments without documentation. Accepting rent in cash is not illegal, but failing to keep records is. The CRA tends to audit landlords whose reported income doesn't align with market rent or local property values. They may ask for proof of cash deposits, tenant receipts, or lease agreements. If they suspect undeclared cash income, they can reassess multiple prior years with interest and penalties. Large renovation or repair claims. Significant expenses for repairs or renovations often attract CRA scrutiny. They want to know whether those expenses should be capitalized, added to your property's value and depreciated, or deducted immediately as maintenance. If your expenses look more like improvements than repairs, the CRA will adjust them and potentially audit the next year too. Use of personal or foreign accounts. If you mix rental income with personal transactions or deposit rent into a foreign account, the CRA might view that as a red flag. Keeping a dedicated Canadian bank account for your property makes your filings cleaner and more credible. The bottom line, a CRA audit doesn't have to be scary if your records are clean, your filings are consistent, and your deductions are reasonable. Think of compliance as your insurance. It prevents small mistakes from turning into big problems. If you require assistance with Canadian tax matters, our team is ready to provide reliable professional support. Please contact us at 416-283-8774 or visit theaccountingandtax.com for more information. And if you found this video helpful, don't forget to like, subscribe, and share.